Good afternoon, ladies and gentlemen, and welcome to September's installment of Market Moves and Insights, where we unpack the latest headlines and market swings to help you see the forest from the trees. Before we dive in, I want to quickly mention DF Direct, our platform that's perfect for clients who wants a simple, low-cost, and automated way to invest. This is a robo-advisor. This robo-advisor can make investing a whole lot easier for US expats, so stick around to the very end where I go into more details. Now, as always, a quick note from our compliance team. Dunhill Financial is a registered investment advisor. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified advisor or a tax advisor professional before implementing any strategy discussed herein. With that out of the way, Dimitrio, what are we talking about today?
Thanks, Paulina, and welcome everyone. So today's agenda is very straightforward. We'll start with a recap of how markets moved in August. Then we'll dive into the portfolio changes we made, specifically our exit from healthcare, BHT ETF, and the addition of emerging markets through AVEM. From there, we'll look at the impact on overall positioning and currency exposure, and finish with the key macro themes to watch as we head into the final quarter of the year. So let's get started. Cam, how did markets move in August, and what stood out across equities, bonds, and currencies?
Excellent question there, Dimitri, and as always, we've got a lot to unpack. But first of all, thank you for that wonderful introduction there, Paulina. And I can't believe it's actually the third installment of this series. And between the first one and what feels like the third one, so much has gone on in the last 3 months that I think there's quite a bit here to unpack. But if we take a step back and look at the overall markets as a whole, the last 9 months has been pretty much a roller coaster of a ride. But despite all of the turbulence, actually, markets are back at their all-time highs, especially US markets, which were lagging quite significantly in the earlier half of this year. They've caught up to some extent, not quite getting on par with the international markets, which we'll address a little bit later. But we've seen a broad recovery across the equity sphere, really being driven by those strong growth story names like your Nvidia, Microsoft, Apple, i.e., your tech names, particularly the Magnificent Seven, leading the pack there. Now, that's what's happening on the equity front. What's a little bit more concerning, I should say, or stuff that should be paid a little bit more attention to, is what's going on in the currency sphere. Now, early on this year, we've had a pretty substantial decline in the US dollar. I think in our second installment, we were potentially talking about a potential recovery in the dollar just because of the sheer pace of that decline that we saw. And since then, it's declined even further, actually. And I think, the US dollar is at that pivotal point now. And especially today, as we enter into the Fed meeting with potential of a rate cut speculation. Well, it's all but guaranteed, actually, at this point. If you look at the futures market, that we will get some form of rate cut, which is probably going to be a net negative for the dollar. But on the fixed income side, I think longer duration assets can benefit a little bit from that perspective there. So that's what's kind of going on a 10-foot overview when we look at sort of equities, currencies, fixed income. I think some of the alternative assets like commodities, they've held quite steadfast, particularly led by precious metals like gold, which just broke 3,500 an ounce actually last week, and now we're sort of inching towards that 3,700 level there, which really underscores the overall uncertainty that the markets are still trying to navigate as we enter into the last couple of months of 2025.
Thanks, Cam. That gives us a solid snapshot of how August played out across the board. I think that's the time to turn to the portfolio changes. One of the bigger moves that we made was fully exiting our healthcare allocation. Why did we decide to step out of VHT, our healthcare allocation, and what were the main factors behind this call?
So that's a really interesting aspect there, Dimitro. And I think let's take a step back for our audience and for our clients here that are watching this webcast. If we rewind the clock back to earlier this year, January of 2025, the reason we actually decided to get into that healthcare position in the first place was coming into 2025, before the tariff uncertainty and before all the political theatrics came into the woodworks, it was pretty clear that valuations, especially in the tech part of the market, were quite expensive and getting towards the upper end of the spectrum from a historical perspective. So here at Dunhill Financial, what we try to do when it comes to our model allocation, especially in some of our satellite buckets there, is look at how can we bring down the overall valuations of our clients' portfolios so that in uncertain periods where we do get pullbacks or markets tend to get a little bit jittery, where can we be positioning to still participate in some of that earnings growth potential or growth, I should say, but again, picking up sectors that are at discounts, i.e. their valuations are much more attractive. Now, healthcare was one of those things that really stood out to us. And actually, there was a great research piece from the JP Morgan Asset Management team, which recalled that, basically, if we looked at all the different sectors that made up the overall S&P 500, it's no surprise that tech probably had the best earnings growth, next 12 months earnings growth potential for the year, which was at sort of 19%, I think is what the forecast was from JP Morgan. And healthcare, surprisingly, had a next 12 months earnings growth potential of 17%. So again, very similar earnings growth potential there as tech, but the key factor there was the valuations. Tech had a forward PE of 29, which it's no surprise to anybody that tech has always traded and commanded a lofty premium just because of all that forward growth, which is what you're really buying some of those names for. But more importantly, healthcare had a forward price to earnings ratio of 16. Now just to break it down for our audience here of what is price to earnings. Price to earnings just really gives us a good gauge of how expensive or undervalued a particular sector is compared to the overall market. And the overall market, as of January 2025, was trading at a forward PE of 22 times. So that's the overall S&P 500 index. And as you can imagine, with that framework to hand in those numbers, healthcare seemed like an extremely attractive place to be, because not only were you getting good earnings growth potential, but you were getting it at a much cheaper valuation. So all those factors compounding, it was a good place to be. Since then, things have changed quite drastically in the last 9 months. And what we've really seen come to the forefront is some of those regulatory headwinds take front seat in this discussion on healthcare as a whole. And I think the reason is that regardless of which political spectrum you sit in, and we're certainly by no means going to get political on this webcast here, it's become very much in vogue to attack the healthcare and pharmaceutical sector, particularly in the US, due to the confluence of factors there, whether it was denying excessive claims from insurance aspects, or cost-cutting reductions and jacking up the health premiums that many customers were paying. I think all of a sudden politicians have come to the realization that if this is the biggest pain point for their constituents, it's a nice easy target for them to go after and claim victory on that aspect. So from those regulatory headwinds there, the margins have come under pressure, and the likelihood that they'll recover is probably getting slimmer by the day. And what I mean by that, if we look at some of those, if we break down what why healthcare as a sector had very good earnings growth, part of that was probably, those double-digit margin growths were probably coming off the back of jacking up insurance premiums for clients, denying excessive claims, and just general cost cutting reductions. And all of a sudden, when the government or regulators are stepping in and asking questions, it becomes very difficult for some of these companies to continue as they have been, in the last couple of years. And that's not to say this is rightful or wrong. And from a societal perspective, I think it's definitely a noble cause. But purely looking at the fundamentals, I think the data has changed and so forth, and therefore our framework has evolved. And so from that perspective, we've decided to completely exit out of that healthcare position and reorient the proceeds elsewhere.
Got it. That makes perfect sense. So stepping away from the sector facing policy headwinds frees up room for more constructive opportunities right now. And let's talk about that. Let's talk about where the capital went. And so, as I said earlier, we did introduce emerging markets. So why did we choose to add exposure to emerging markets through AVEM, and why exactly now?
Again, I think emerging markets are at that crucial juncture where, especially with all the headlines and the tariff negotiations still ongoing, and some of them actually coming to sort of a conclusion. I think the reason we've decided to get back into EM, and I want to stress the part of getting back into it, is historically for the last 3 years or about thereabouts, we've been underweight emerging markets because of the political aspect. And there was a whole lot of uncertainty within the EM complex that needed to be worked through, particularly in China, because they had the real estate crises and, everything else going on. It was just a very volatile period. And by having this shift, basically, we're not making an outright strategic bet that emerging markets are going to be the next best thing. Again, all we're doing by this tactical shift is getting our EM exposure back up to neutral weight. I think if we look at the MSCI ACWI All Country Index, EM makes up about 12%. Our portfolios had about 10% is what the EM exposure was, 9 to 10%. And by essentially this pivot, we're bringing that back up to neutral weight. Could it go back up to an overweight? Potentially, but the main catalyst for getting back into EM, if we look at it, is really the currency drivers. I mean, it's no surprise to a lot of our clients, particularly on the international front, the dollar has declined by about 10% again against a basket of currencies there. And that deterioration in the dollar strength is always beneficial to emerging markets, right? Because A, they have a lot of their debts in US dollars. So if the US dollar deteriorates, financing some of those debt obligations become very, very attractive. But more importantly, the valuation discounts that we're seeing in the emerging market complex have just gone to the point where they're too attractive to ignore. And what I mean by that is, if we look at the whole index, MSCI Emerging Market Index has a forward P of about 12 to 13. So just let that sink in. Early on, we were just talking about some of the valuations in the US sector, right? So the S&P 500 trades at a 22 to 23x forward multiple. Emerging markets are at 12 to 13. So almost a 50% discount there. Now, if we break that down even further, some parts are a little bit expensive, some parts are a little bit cheap. For example, India is still very expensive at 22 to 23 times forward multiple. So again, on par with the US there, but we won't dive into that in too much depth. But if you look at some of the other segments there, like China, like Taiwan, and some of the other drivers in the emerging market complex, they're still trading at very cheap valuations. We're talking forward PEs of sort of 12 to 13x. So valuations are still extremely attractive in that emerging market complex there. So by getting taking advantage of those lower valuations, and the fact that we've got the currency sort of tailwinds in our favor, all of that leads to sort of adding that EM exposure there into the portfolios. And I think today, as we get that Fed rate cut decision, as interest rates start to come down in the US, I think emerging markets could look even more attractive in the coming months and quarters ahead. But again, what we're doing with the portfolios is remaining dynamic, and as the data changes, we're positioning accordingly.
Well, that's excellent point, because I just wanted to suggest to take a step back and look at the bigger picture. With healthcare out and emerging markets now brought up to the neutral weight, as you said, how does this shift affect our overall portfolio position, and not just regionally, but also in terms of currency exposure and any other sort of diversifications?
Absolutely. So heading into this year, I think one of the things that we sort of underestimated was the sheer decline of the dollar. As I mentioned, the administration, the current administration in the U.S., did say they wanted a weaker dollar. The question was, how weak of a dollar did they want? Now that we're sitting at a sort of a 10% decline, peak to trough from January till now, the question that we all have to ask ourselves is, does that mean mission accomplished, and they've achieved their objectives by any means necessary, or is there something more grandiose in the works? Unfortunately, that's something that we still haven't quite determined yet, just because it's a very evolving situation. I think one tweet can change everything overnight, and that's the uncertainty aspect there coming back into play. So what we have done, though, since the beginning of the year till now, is we've gradually been decreasing some of our US exposure from a regional basis, as you mentioned, Dimitro, and positioning more in an international approach, particularly in Europe and other developed markets, and a little bit into emerging markets as well, as you mentioned. And I think between the weaker dollar story and also the fact that we've finally got real growth opportunities outside the US, particularly, for example, Europe. The Germany, for example, lifting their debt brake that they've had for a very long time, and spending about 500 billion euros on infrastructure spending, and another 500 on sort of military and industrial rearmament. Again, those are all great catalysts there for continued growth in the European region. So what we're looking to do is just position tactically in that, and make sure we're not sort of having all our eggs in one basket by having an overweight to the US, which in the last 10 or 15 years, it's been very beneficial to many of our clients having an overweight to the US dollar. But again, currencies, I think even our director here, Brian, will probably agree ad verbatim that the US dollar typically moves in a 10 to 15 year cycle. We have 10 to 15 years of a strong dollar, 10 to 15 years of a weak dollar, rinse and repeat, ever since the US dollar broke off the Bretton Woods standard, at least. And I think it's long overdue that we've gotten to the point that the dollar finally starts to decline. And then I think the real question here going forward that we'll need to ascertain is, will it be a controlled decline in the dollar, or do we get some sort of disorderly exit there, which that'll cause problems in its own right. But I think the main aspect there is continuing to diversify, making sure the portfolios are international, and more importantly, actually, I would say making sure that the safe part of the portfolios, which is particularly the fixed income side, it's in the currencies that our clients will actually be spending it in. I think for a lot of our clients, what we've been doing is allocating into international, European, and GBP sterling fixed income, just to mitigate and hedge some of that currency risk there. And if you haven't been having these conversations with your advisors, please do reach out to them to set up that conversation, and we'll be happy to walk you through that.
Oh, thank you, Cam, because this breakdown was really great and helpful for many of our viewers. With the Fed meeting today, as you already mentioned, what are the key macro themes you'll be watching as we move into the final quarter of the year, especially in light of today's Fed decision? Would it be a very crucial decision? Would it affect a lot, or it's just another one?
I think this particular Fed meeting, Dimitro, is going to be an interesting one. Not only from the political television that it's going to provide, because I think every Fed meeting, especially in the last couple of quarters, has been anything but entertaining. But I think this one is going to be particularly important just because of the tone that it sets going forward. And what I mean by that is it's all but guaranteed that we'll be getting some sort of easing and a rate cut. The question is it 25 basis points and that's it? It's a one-off, one and done deal, or is this the beginning of an easing cycle, right? And I think once we get some clarity into that, that's really going to take us down one of two paths, right? One path is going to be that's going to be a net negative for the US dollar, just because of the way the interest rate differentials and the short-term momentum traders will work. As those interest rate differentials between the dollar and other currencies narrows, you're going to start to see flows out of the US dollar, right? That's just a function of the markets there. So we could be in for some short-term declines in the dollar just off the back of that. Now, the more important factor, though, is how that potentially plays out with inflation. Now, and actually, the reason the Fed is probably cutting rates is because of the deterioration in the labor markets, right? As hiring slows down and the job market becomes a little bit more uncertain, one of the mandates that the Federal Reserve has is maximum unemployment. So they'll want to ease conditions to make sure the economy doesn't fall too far behind there. But at the same time, inflation is still at 2.9%. That was the latest reading in the US at least, right? So it's still well above the target of 2% that they've had for quite some time now. So then the key question that the Fed will have to tackle is, how do they balance that dual mandate? If they cut too aggressively, too quickly, it could stoke inflation back again. So the economy runs slightly more hot. Risk assets obviously take another leg up, but then inflation, comes roaring back as it did in the 1970s and 80s. And I think that's a key risk that a lot of the Fed will want to avoid, particularly Jay Powell. I think, early on when we had the bout of inflation in 22 and 23, they made the risk of, labeling it as transitory, which I think it still haunts them to this day. And what they'll want to avoid is a repeat of that scenario, but more importantly, a repeat of the 1970s and 80s. And, because back then inflation spiked up to double-digit percentages. And the remedy for that was a very painful process of jacking up interest rates up to double-digit percentages. Now, it's not to say we'll probably get a repeat of that, but I think those are the key aspects there, is to keep an eye on how US CPI plays out in the next couple of months for the rest of this year and into 2026. If that does start to tick up, as we discussed in our last webcast, we've got that commodity position there, which is acting as a ballast in the portfolio for a high inflation period if we do end up seeing a return to that. So, we've got the different tools in the tool shed there when it comes to a portfolio construction. And if CPI does trend up in the wrong direction, our clients can expect to see that commodity position increase in lockstep. But I think until then, it's remaining vigilant on both the dollar and inflation, and keeping those two front and center.
Well, thank you both so much, and thank you to everyone joining us today. Before we close, I'd like to quickly circle back to DF Direct, because investing as an expat often feels complicated with high minimums, complex tax rules, and too many choices. And DF Direct was built to simplify that. It's a low-cost, no minimum robo solution, and it's fully US tax compliant. It only takes a few minutes to sign up, and you can visit dfdirect.com to get started or reach out to us directly. On behalf of everyone here at Dunhill Financial, thank you once again for tuning in, and we look forward to seeing you next time.
Thank you very much for hosting, Paulina, and thank you, Dimitri, for those excellent questions there. And thank you to our audience for tuning in. And until next time.
Yeah, thank you, Ken. See you guys.